Welcome to the Hurst Trading Room. This is a video update that I'm recording on the 12th of August 2013. But unlike usual video updates, I'm not going to be identifying trading opportunities in the markets for the week ahead. Instead, I'm going to be looking back over the trading that we have performed in the Hurst Trading since November of 2012, and I'm going to be taking a look at how the portfolio of 4 instruments that we were discussing trading opportunities in would have performed over that time. And so, as always, because we are discussing trading, it is very important that you read and make sure that you have understood these disclaimers, particularly the hypothetical disclaimer, because, of course, all the trading that I will be speaking about is hypothetical trading that we took in the markets that were discussed in the Hurst Trading Room. Well, let's get straight to it. Here is an equity curve, an equity graph of the portfolio of the 4 instruments that I discussed every week in the Hurst Trading Room. Of course, I did occasionally discuss other instruments and mention other trades, but I haven't included any of those here because we were tracking on a regular basis these 4 instruments: the euro to US dollar, the British pound to US dollar, the NASDAQ and the S&P 500. And so I have taken the trades that I performed in those 4 instruments as identified in the Hurst Trading Room videos, and I have compiled them, and using the Portfolio Manager feature of Sentient Trader, I've put them together into a portfolio. And here is that equity graph. So there are a few things to be said about it. The first is that the equity graph starts on the 19th of November. Okay, and the reason for that is because we announced our first FLD trading strategy course in the Hurst Cycles Trading Academy at the end of October, and our first group of students spent their first 4 weeks understanding the technical details of the trading system, and then we started trading, or at least identifying trading opportunities in the week of the 19th of November 2012, and I recorded my first video which actually identified those trading opportunities on that Monday, the 19th of November. And the other thing to notice is that the portfolio results I'm presenting here go up until the 12th of July 2013. And you might remember, if you've been watching the Hurst Trading Room videos, that of course I stopped recording Hurst Trading Room videos because I went on a summer break on the 17th of June. And that's way back here. So why is it that our portfolio continues after that date? Well, what I always do, and as I have mentioned before, when I take a holiday, if I have open trades, I will usually allow them to run their full course. I won't identify new trading opportunities, but I will monitor the currently open trades that I have, and that is exactly what I did. And as you can see, those trades kept making a little bit of money for me, and we finally closed out the final euro US dollar trade on the 11th of July. As a matter of interest, that is also why the equity curve flattens out a bit at the end there, because of course I wasn't entering into new trades. I was just letting the open trades run to their natural end. And so that's why we have a little bit of a flattening of the equity curve at the end, because there are no new trades being taken. And so when you consider the results of this portfolio, that's also something to bear in mind, that for almost the last month of the period that we were considering, no new trades were being entered into. There's something else that really jumps out at you, I'm sure, which is what happened during this period of time here. Okay, that was the end of February and into March, and as you can see, our equity curve flatlines for a period of almost 5 weeks. Why did that happen? Well, if you go back and take a look at the videos at that time, you will know that it was fairly difficult to make clear trading decisions during that period, because it was obvious that a dominant cycle was gripping the markets. And when a dominant cycle grips the markets, if you haven't been fortunate enough to get into those trades, then it's very difficult to get into a new trade because the dominant cycle will simply pull the market up in one direction, and you don't get new entry opportunities according to the FLD trading strategy. And so that was a fairly frustrating time because trading decisions were fairly difficult to make, and as a result our equity curve sort of flattened out. The good thing, of course, is that we didn't lose money during that time. But it was a time where we sort of trod water a little bit. We just waited until we got good, clear opportunities. I believe that if a trading opportunity is not clear and obvious, then one should rather not take it. I don't believe in jumping into trades just for the thrill of trading. If opportunities aren't clear and obvious, then it's best not to trade. And that's what we spent most of March doing. In retrospect, we could have gone away and taken a holiday, but of course at the time every week we were looking for new trading opportunities, but there weren't many that were coming out of the markets, and so we resumed our trading when the market action became much clearer, the cycle action became clearer in April, and so that's why there's a bit of a flat line there in March. Okay, so that's the equity graph. That's the result of combining the trades that we took in these four instruments. Something else I haven't mentioned is, of course, there are three lines here. There's a blue line. That blue line is the equity line. So we were trading on end-of-day charts, daily bars. So each day the equity would be recalculated by a sentient trader. The green line is the maximum sort of favorable excursion. In other words, if on an intraday basis we made extra money on those trades, then the green line shows that up above the blue line, of course, and the red line shows the maximum adverse excursion or the maximum drawdown. And so you can see the red line is constantly below the blue line, of course, because on an intraday basis, as the markets moved up and down, of course there were times when we weren't doing as well as we did at the close of the day, perhaps. Okay, so that's what those three lines mean. Having taken a look at the equity graph, let's take a look at the summary, the numbers, if you're more of a numbers person and less of a graph, a visual person. Here are the numbers. First of all, of course, we can see the period of time that the portfolio was generated over. As you can see, I hope you're not put off by the fact that this is an Italian computer, and so it gives you the day of the week and the month in Italian. Because it's a computer that likes speaking Italian, obviously. And so you can see the report for this equity, for this portfolio. It's from the 19th of November 2012 until Friday the 12th of July 2013. The diversity rating I won't speak about much here. That's something that doesn't really apply to what we're discussing, except to say that we do trade closely correlated instruments, which is an aspect of the FLD trading strategy, that you do choose closely correlated instruments, because when you're not sure what's happening in one instrument, you can be doing something different in another closely correlated instrument. So it's an important thing, and you can see how the correlation of these instruments match, such as the Euro US dollar, the British pound US dollar, have very, very close diversity ratings. So that's not really any big surprise. Let's take a look at the numbers, which are really important. First of all, many people look at the win ratio of any trading strategy. As you can see, the win ratio in the trades that we took was 74%. In other words, 74% of our trades were winning trades. That's a pretty good win ratio. Win ratio on its own isn't really very important, I don't believe, but it is one of the figures, certainly, that people look at. Much more important are things such as the average win to the average loss. So let's have a look at that. The average win to the average loss, as you can see here, is a ratio of 2.25 to 1. There shouldn't be a dot there. 2.25 to 1 is the average win to the average loss. In other words, our average winning trade was 2.25 times bigger than our average losing trade. And in fact, those numbers are given to us right over there. Our average winning trade was 300 call it $300, and our average losing trade was minus $136. Okay, so that's also good news, because that, I believe, is a much more important figure to look at when you're considering a trading system. Is your average winning trade going to be bigger than your average losing trade? Of course, all of these figures work together to give you an overall picture of what the trading strategy is all about. The 74% win ratio can also be expressed as a ratio of 2.77 to 1. As you can see, profit factor 1 over there. I won't bother writing that down. It's not very important. Okay, this is a very important ratio for many people. 6.24 to 1 is the size of our total wins against our total losses. So that's a very high figure. Very high figure, actually, and it certainly indicates that this is a profitable trading strategy. Okay, there are several other figures here. Let's go through them. Let's just scroll down a bit. As a matter of interest, all of these charts and summaries that I'm showing you are available for download from the page in which you are viewing this video in the Hurst Cycles Trading Academy. So you can download them and peruse them at will, and go through all these figures in detail. I'm going to be sort of rushing through them a little bit. Total time period, you can see here, almost 8 months, 7 months and 3 weeks. Although, of course, as we know, the last 3 weeks of that I was actually on holiday, so it's really only about 7 months. Total time in trades is over 2 years. How's that possible? Well, because of course we take 3 trades for every trading opportunity. So that's why the total time in trades is so much more than the actual time. And the same thing is true of the percentage time in trade. Some people want to know, what percentage of the time am I going to be in the market? Well, you can see we were in the market 337% of the time. What does that actually mean? Well, we're trading 4 instruments, and we take 3 trades per trading opportunity. So if we were in trades all the time on every single opportunity, we would have been in 12 trades all the time, which would have worked out at 1200%. Okay, the fact that we are in trades 300% of the time means that on average we are in about 3 trades at any one time. That's quite an important figure if you're considering trading this strategy. On average, you're going to be in 3 trades at any one time, or just over 3 trades, 3.5 trades, call it. Okay, total time in winning trades, losing trades, interesting figures. You can see obviously we spent more time in winning trades than losing trades. So generally you would have spent more time feeling warm, fuzzy thoughts about your trading than you would have feeling sort of depressed, angry thoughts about it. That's a good thing. The average duration of our winning trade was 1 week, and the average duration of our losing trade was 5 days. Those aren't really particularly interesting figures because, as you know, our 3 trades have different durations, and in the FLD trading strategy I present a pretty accurate estimate of how long we will spend in any trades. As you know, our trade 1 we will often be in for only a day or 2. Our trade 2 we would often be in for about a week. Our trade 3 we sometimes are in for 2 or 3 weeks. And our losing trades are often much shorter. So those aren't particularly interesting figures. Okay, here is possibly the most interesting figure, and that is the annualized percentage return, 34%. Okay, so in other words, we were making 34% on our money by trading this portfolio of 4 instruments. Now I've got several things to say about that, and I'll come back to this in a moment. But that 34% is a very good figure. I doubt that your bank is giving you those kinds of figures, but of course that figure must be considered in the light of the amount of risk that you are taking. It's all very well to make 34% annualized return, but if you're risking losing quite a lot, then that's not so good. So what was our risk? Well, that is expressed in the maximum drawdown, as you can see. The drawdown is the maximum amount that our account was drawn down upon. In other words, how much money do we lose in the account during the period under consideration here. And as you can see, that is 2.96%. Let's call it 3%. So our drawdown was minus 3%. So in other words, we made an annualized percentage return of 34%, and our maximum drawdown at any one time, our maximum drawdown was 3%. So the worst situation when we were losing was, in fact, we were losing 3% on our account. Okay, that was as a matter of interest on the 2nd of January 2013. And that was actually because I didn't close out my trades on New Year's Eve, although in retrospect I should have. But anyway, that's the maximum drawdown, minus 3%. Now, there are some things that I would like to say about those figures. First of all, the 34% annualized return and the minus 3% drawdown, of course. Those figures were on the basis of trading a portfolio of only 4 instruments. That is because we chose 4 instruments to form the core of our Hurst trading room portfolio. And for students of the FLD trading strategy, we encourage them to find at least another 4 instruments, if not another 8, so that they were trading portfolios of 8 to 12 instruments, which is, I believe, about the right size portfolio that you would want to be trading on an end-of-day basis using the FLD trading strategy as a trading methodology. We had only 4 core instruments because we encouraged our students to trade these 4 instruments, to trade along with the Hurst Trading Room videos, and to extend what they were learning in these 4 instruments to the other instruments that they were trading. Now, the position sizing and the amount that we were trading was not affected by the number of instruments that we were trading. It was affected by the amount of risk that we were willing to take per trading opportunity. And so if you had been trading twice as many instruments, if you had been trading 8 instruments, for instance, then realistically you could expect those numbers to be doubled. Okay, they might not have been quite doubled because you might have been taking less risk because you were trading more instruments, although in fact the level of our risk was very, very low. As I kept mentioning in the Hurst Trading Room videos and in the FLD trading strategy material, we take very little risk, only 2% per trading opportunity spread over 3 trades and adjusted for underlying trends. So most of the time we were only taking 1% risk per trading opportunity split across our 3 trades. And so if you had been trading 8 instruments in your portfolio, it is reasonable to assume that you could be seeing those numbers doubled in size, because you would have been making twice as much money with twice as many trades, but also, of course, taking twice the amount of risk. And so your drawdown would have been about 6%. Of course, as you add more instruments to a portfolio, you might want to reduce the level of risk for the trades that you're taking in each one of those instruments. But the level of risk that we were taking was particularly chosen to handle a portfolio of 8 to 12 instruments. So chances are you would have taken the same amount of risk in those extra instruments, and so it is not unrealistic, I don't think, to say that those numbers could have been doubled if you had been trading a portfolio of 8 instruments. Speaking about risk, in the FLD trading strategy we recommend starting off by taking only a 2% risk per trading opportunity. Okay, and I recommend starting at that level until you get an idea of how the trading methodology performs, at which point you could increase the level of risk that you're taking per trading opportunity in each one of your instruments. So let's assume that you were trading 8 instruments, and over the past 7 months you've experienced a maximum drawdown of 6% on your account. Okay, which is this figure over here. Now, a drawdown of 6% on the account is acceptable to most people. Some people might say, okay, they don't want to take any more risk than that. 6% is fine. They're happy with that, and that's fine if that's your level of risk. Many people recommend that you double the maximum drawdown that you have experienced, and say that in fact you might experience double that drawdown. So in fact, you're looking at a figure of about minus 12% if you agree that you should double what has happened historically and be prepared to accept things being twice as bad as they were before. And so some people might say, okay, so I'm happy with a 12% drawdown on my account, and so I'm going to stick with the 2% level of risk. Some people would be happy to extend that a little bit further. And so if, for instance, you had increased your risk per trading opportunity to 3%, okay, that's 50% higher, that's 3% per trading opportunity. If that were the case, you'd be looking at an annualized percentage return of around about 100%. Okay, and you'd be looking at a maximum drawdown of around about 9%. Okay, but if you wanted to double that, then of course you would be considering getting close to a 20% drawdown on your account, which is probably about the maximum amount of risk that most people would consider trading. And so the annualized percentage return of 34% is in fact a number which you need to consider in terms of how many instruments you would have traded, and also what level of risk you would have used per trading opportunity. And so this portfolio represents a sort of an entry-level, low-risk, 2% per trading opportunity, trading only 4 instruments, very, very low-level, entry-level, minimum risk approach, and you're making a 34% annualized percentage return. So it is, I believe, a very good figure. Of course, these are hypothetical trades that we're speaking about, and trading costs have not been included, and so trading costs will reduce those numbers further. I would encourage you to download the summaries and the graphs for all of the instruments and for the portfolio as a whole from the page on which you're watching this video in the Hurst Cycles Trading Academy, and take a look at them and consider them carefully, because there is a lot of very interesting information in here. Let's move on. I'm not going to dwell on each of the individual instruments at length. Here is a list of all the closed trades, and you can download this from the page you're watching this video on as well, and you can see all of the trades that are included in the portfolio, and you can go back and you can look at those Hurst Trading Room videos again, and you can identify each one of these particular trades, and there they are. There were 117 trades altogether. Interestingly, there were almost an equal number of long trades and short trades, 60 long trades and 57 short trades. I'm not quite sure why that happened, but very, very nearly equal number of long trades and short trades. Right, let's have a look at each one of the individual instruments. And again, you can download these graphs and summaries, and you can study them at leisure, and you can see for yourself how each of the instruments has performed. First of all, here is the euro to US dollar, and a few interesting things to point out about the euro to US dollar. First of all, for a period of 3.5 weeks in March, we did no trading in the euro to US dollar, because, of course, all the markets were a little bit difficult to analyze, and so we didn't do much trading during that time. And you can see that our equity curve comes right up to the end, because, of course, the euro to US dollar was the last instrument that had an open trade as I was taking my summer holiday. And here is the summary page for the euro to US dollar. Interesting figures down here at the bottom. You can have a look at all of the profit factors and all that kind of thing, but down here at the bottom you will see the annualized percentage return on the euro to US dollar was 11%. That might not sound very good. It's not very good, but you must remember that the FLD trading strategy is all about trading a portfolio of instruments. You don't just choose one instrument. If you were making 11% and that was all you were doing, then you might well be disappointed. But of course, this is only one instrument in a portfolio, and they all combine to produce a much better result. There's something to be said about the maximum drawdown on the individual pages. They are calculated differently. You can see here in brackets it says as a percentage of maximum profit. Because of the way in which Sentient Trader calculates the portfolio values, it doesn't consider the maximum drawdown in each instrument as being a drawdown in the entire portfolio. That figure is presented on the summary of the portfolio. So there's a different figure presented for your interest on the page, the summary page for each individual instrument. And here you can see that's minus 12% basically. But it is not a drawdown for the equity value, but it is as a percentage of maximum profit. Okay, so in this particular instrument, during the period of time under consideration, the maximum profit that we had made in the euro to US dollar, how much of that did we give back? We gave back, of the maximum profit we'd made out of the euro to US dollar, we gave back 12%. Okay, so that's a slightly different figure, just really for your interest. And another important figure for many people, of course, is the win ratio. 81% of our trades in the euro to US dollar were profitable. I find the euro to US dollar really, really good to trade using the FLD trading strategy. It just has very clear cycles. So 81% win ratio is, of course, a very good figure. Let's take a look at the British pound to US dollar. Here you can see the equity graph. The British pound to US dollar, I mentioned several times in the videos that I've recorded over the past 7 or 8 months, has been my favorite instrument because we just kept making money out of it. There was a period here of about 5 weeks when we didn't make any trades in the British pound to US dollar. It was when it was forming a very major trough, and I didn't want to jump into trades too early. We made a few losing trades here before that trough was reached, and then we stopped trading this instrument for a few weeks, and as you can see, it just kept going up. For the last 4 weeks or so, there was also no trading activity at all in the British pound to US dollar. Let's take a look at the summary page for the British pound to US dollar, and here as well you can see why the British pound to US dollar was my favorite instrument. A win ratio of 83%. Okay, that's really good, and you can see some other really good profit factors down there. You can download this page and have a look at it. What about the annualized percentage return? Well, for the British pound to US dollar, it was about 11.5% annualized percentage return. Again, not very good, but that's because this is only one of our instruments in our portfolio, and so we didn't expect it to do much better than that. In fact, anything above 8%, I think, is pretty good for an individual instrument in your portfolio. The maximum drawdown, which is of course not the drawdown, but it is the percentage of the maximum profit that we gave back, was about 10%. So we only gave back about 10% of the maximum profit that we made in the British pound to US dollar. So that's a pretty good figure, actually. Okay, let's take a look at the NASDAQ. The NASDAQ we did fairly well out of, although as you can see, it's a much more bumpy chart than the British pound to US dollar, and you can see here we did very nicely here. Then in January, of course, on New Year's Day, in fact, you will probably remember, the markets turned around and rocketed upwards, and we were stopped out of our short trades, and we missed our opportunity to get into the trade. So for 5 weeks, or was that 6 weeks, for a long time in the NASDAQ, it was very frustrating because the market kept moving up and we couldn't get into any trades. Very frustrating time here in January, but a frustrating time is better than a losing time, I always say. So that's what happened in January. Then in February we made a little bit of money, and then again another 5-week period, which was also very frustrating because the markets were moving strongly and we just didn't manage to get in there. We did finally get in the beginning of April, got into the market and made some good money in the NASDAQ. Again, the last 5 or 6 weeks we weren't in any trades. So there are quite a lot of dull moments in the NASDAQ. That's just the way that things worked out in the markets at that time. Let's take a look at the summary page for the NASDAQ. Here it is. And let's just scroll down. Okay, so first of all, our win ratio in the NASDAQ is much lower than it was in either of the forex pairs. Not surprising, it was a fairly challenging time to be trading in the US indices. It was a win ratio of only 67%. Nevertheless, still better than 50%, so we were still winning more trades than we were losing, and various other profit factors there which you can look at. Our annualized percentage return was only 8%. Not great, but it was only one instrument in the portfolio. The maximum drawdown as a percentage of the maximum profit, you can see over there, is very big. That's 27%. Now, that's not a normal maximum drawdown figure, I'll say again. It's how much of our maximum profit did we give back. So of all the money we made in our NASDAQ, we actually ended up giving just over a quarter of it back. So we lost just over a quarter of the maximum profit that we ever made. That is a much bigger figure than we saw in the forex pairs. I think it's because the US markets were at times fairly challenging. What happened quite often in the US markets was that as an analyst, I was convinced the markets were peaking and were turning down. But following the rules of the FLD trading strategy, I was still entering into long trades. But I think that your analysis brain, if you like, always has an influence on your trading. And I think that possibly the fact that we handed back a quarter of our profits in the NASDAQ at the worst point in the 7-month period had to do with that conflict between my analyst brain and my trader brain. It certainly did reduce the performance slightly. But nevertheless, I was very happy to have included the NASDAQ in my portfolio, because if we take a look at the S&P 500, you will see an example of a pretty poor performance. Still a winning performance. You can see we still made money here. Let me change the color of the pen. We still did make some money in the S&P 500, but not very much, as you can see, and you can see how we really did well in November up to the end of December. On New Year, just before New Year, of course, we handed back a lot of that profit, and that will probably be our sort of maximum drawdown figure somewhere over there, or possibly from maximum profit down to there, something like that. And then we made very few trades in the S&P 500. Okay, we made a winning trade here, another winning trade there, and a losing trade over there. So very few trades in the S&P 500. Why was that? Well, it was because the markets were proving to be a little bit difficult to analyze and to trade. As I've mentioned, the dominant cycle gripping the markets made things a little bit tricky. And that is why, or this is why, I trade two closely correlated instruments, or more than two closely correlated instruments in the portfolio. Because when you're not sure what is happening in the market, I prefer to take a trade, but I will choose to take a trade in only one of the closely correlated instruments. And in this particular case, or over the 7-month period, I was taking more trades in the NASDAQ than I was in the S&P 500, because the S&P 500, to be honest, wasn't giving very clear signals, whereas the NASDAQ signals were a little bit clearer. And that is the big advantage of trading two closely correlated instruments. I wasn't making a lot of very big mistakes, but I wasn't getting anywhere, as you can see, with the S&P 500. But it didn't matter, because I was trading the closely correlated instrument of the NASDAQ, and if we go back to the NASDAQ graph, you can see I was making money in the NASDAQ when I was pretty much getting nowhere in the S&P 500. Let's take a look at the summary of the S&P 500. Not painting a very good picture, of course, but nevertheless not a losing instrument. You can see the annualized percentage return is only 1.75%. That's pretty miserable, isn't it? But it was an important instrument to have included in our portfolio. Would I leave it out? No, definitely not. Because it provides a foil, if you like, for the NASDAQ. These two instruments work together. So I'm not going to cut the S&P 500 out of my portfolio because it performed badly. It performed badly because when there was analysis uncertainty, I chose to make trades in the NASDAQ instead of the S&P 500. And that's why I have those two closely correlated instruments in the portfolio. Okay, our win ratio here was 57%, so we were still winning more trades than we were losing, but there are our profit factors. Not fantastic, but they're all winning profit factors. And in the S&P 500, you can see that we made, on average, almost $5 a day, 4.74. I've written over it, $4.74 a day. We made in the S&P 500, so that's better than a poke in the eye with a sharp stick. So that is the S&P 500. And that concludes my presentation of the results of the trading that we have hypothetically performed in the Hurst trading room over the past 7 or 8 months. There are the results. I'm very pleased with the results. I think that they show the effectiveness of the FLD trading strategy as a strategy for making profitable trades in the market. I'd like to remind you that our trading opportunities were identified in videos on a Monday morning, and so it wasn't as if though I spent hours every single day worrying about what the markets were doing. I made trading decisions fairly quickly by identifying trading opportunities. And you can still go back and take a look at those videos in the Hurst trading room and see how I identified the trading opportunities and how I made the decisions that I did, which led to this hypothetical trading performance. Thank you very much for your time again. Thank you for your interest in the Hurst trading room, in the FLD trading strategy, and for your interest in Hurst cycles. And I look forward to seeing you soon in the Hurst trading room.